There's a moment a lot of people have. You finally open the investing account. You move money in. You feel like you did the thing. A year later you check, and the number hasn't moved. Not because the market had a bad year, because the money never got invested. Opening an account and investing are two different actions. Nobody says that out loud, and confusing them can quietly cost you a year. So let's do this properly. Not with a checklist you've scrolled past 9 times, with the idea underneath that makes the order make sense. Every dollar you have needs a job. The job decides where the dollar goes. Money you might need in 3 months has a completely different job from money you won't touch for 30 years. Put them in the wrong places, and one gets stuck when you need it. The other loses ground for decades. Quick thing, this is education, not advice about your situation. I don't know your job or your debt. You do. Start with the short-term money. Its whole job is to be available. The car makes a sound. The tooth cracks. Your hours get cut. It doesn't need to grow. It needs to be there. So it belongs somewhere boring and reachable, a savings account, where deposits are insured up to $250,000. Here's what surprises people. Money in a fund is not insured that way. Not even if you bought it at a bank. Deposits are protected. Investments aren't. So how much? You've heard 3 to 6 months of expenses. Let me be honest about that number. The federal agency, whose entire job is consumer finance, won't give you one. Their guidance says it depends on your situation, which I love because for a lot of people, 6 months of expenses isn't a goal. It's a wall. So don't start there. Start with the number that covers the annoying thing, not the catastrophe. Every year, the Federal Reserve asks Americans one specific question. Could you cover a surprise $400 expense? In the most recent survey, 63% said yes, entirely from cash or savings. So $400 is a real line, and more than a third of people are on the wrong side of it. If that's you, that's your first target. But those same dollars have something else competing for them. And if you're carrying a credit card balance, it isn't waiting politely while you build a cushion. As of the middle of this year, the average rate on U.S. credit card accounts was around 21%. 21%, compounding against you. Every year, and unlike anything in the market, completely guaranteed. The SEC puts it about as bluntly as a federal agency ever has. Their words. No investment strategy pays off as well as, or with less risk than, eliminating high-interest debt. So if you're carrying a balance like that, paying it down beats basically anything else you do with the same dollar. Highest rate first. Except, and this is exactly where every clean internet checklist falls apart. If your job offers a match, the company puts money in when you do. The IRS's own example of how that works. 50 cents for every dollar you contribute. I won't call that a guaranteed return because it isn't one. It's not a rate, it's your employer adding to your pile once. And sometimes you have to stay a couple of years before it's yours. But it's real money that only exists if you participate. Skip it, and it simply never arrives. So which wins? The 21% card or the match you're walking past? Honestly, the sources don't agree. And anyone who tells you this has one obvious answer is selling you a simpler world than the one you live in. What I can give you is the better question. What is this dollar competing against? A 21% balance is a certain loss. A match is money that otherwise doesn't exist, which is why most people get the match, then attack the card. With the expensive debt handled, finish the cushion. Some people keep up to 6 months of income set aside. Do it before you go further, because retirement accounts have rules about pulling money out early. Before 59 and a half, you can owe an extra 10% on top of normal tax. So your retirement account is not your emergency fund. It's closer to the opposite. Now the part I opened with. There are 2 decisions here, and almost everyone thinks there's one. Decision 1. What box does the money go into? A 401k is a box. A Roth IRA is a box. A brokerage account is a box. What makes them different isn't what's inside, it's how they're taxed and the rules for getting money out. The beginner version. Traditional means you get the tax break now and pay later. Roth means you pay now, and qualified withdrawals later aren't taxed. That's most of what you need. Decision 2, the one people skip, is what you actually put in the box. A fund, a bond, shares of a company, that's the part that grows or doesn't. And here's how you know they're two different things. The IRS says you can open a retirement account at a bank, an insurance company, a fund company, or a stockbroker, and that some investments aren't allowed inside. A rule about what's allowed inside. Something only makes sense if that something is a container, which is exactly how you open the account, move money in, feel finished, and own nothing. The box is on the shelf. The box is empty. 2 decisions: open the box, then fill the box. So what goes in it? You could buy shares in individual companies. It's what investing looks like in movies. But the SEC says it flatly. Own 4 or 5 stocks and you are not diversified. Diversified just means not everything riding on one outcome. Don't put all your eggs in one basket. The SEC's phrase, not mine. Here's the line I'd frame on a wall. A total stock market index fund, one thing you buy, owns stock in thousands of companies. One purchase, thousands of companies. If one implodes on a Tuesday, you barely feel it. An index fund isn't picking winners. It's tracking a whole market. Less trading, usually lower cost. There's also a version that shifts towards safer holdings as a target year approaches. Convenient, but no guarantee you'll end up with enough. And be careful about loading up on your own employer's stock. A bad year there can take your savings and your paycheck in the same week. Now, fees. I can feel you reaching for the scrub bar. Stay with me, this one's worth money. Funds charge a small percentage of your balance every year. 0.25% or 1%. Small enough to ignore, so everybody does. The SEC ran the numbers themselves. $100,000, 20 years, 4% a year. A 0.25% fee leaves you about $208,000. A 1% fee, about $179,000. Same money, same market, same 20 years. $29,000 gone to a difference of 0.75%. You can't control the market. You can read a number before you click buy. Next, make it automatic. The contribution comes out on payday before it lands somewhere you can see it. And let me be precise, because this gets oversold. Automating doesn't make your investments perform better. It deletes the decision, and should I invest this month is a question you'll eventually answer wrong. Investor.gov's example is 5 or 10% of your income, or whatever you can actually sustain. Sustainable beats impressive. Which brings us to the part most videos skip. Your balance is going to go down. Not might. Will. Some years far enough that you feel sick opening the app. That's not a malfunction, it's what you signed up for when you chose growth. The danger was never the drop. It's what people do during it. Sell during a sharp fall that turns out to be temporary, and you've locked in the loss and you're outside when it recovers. And if anyone offers you high returns with little or no risk, that isn't a better product. The SEC lists it as a classic warning sign of fraud. So why go through all of it? Let me show you one number, and this is a hypothetical. I'm choosing a return to demonstrate arithmetic, not predicting anything. $200 a month, 40 years, and let's assume 6% purely as a round number for the math. Not a forecast, not a guarantee. Real years are up a lot, down a lot, rarely anything that tidy. Under those assumptions, you'd finish with about $398,000. And here's what matters. $96,000 of that is money you put in. Everything else is growth. Roughly 3/4 of that ending balance is money nobody deposited. That's what time does. All right, the whole path fast. Give every dollar a job. Short-term money goes somewhere safe and reachable. Build a small buffer first, $400, not 6 months. Kill the high-interest debt, because 21% beats almost any return you'd chase. If there's a match on the table, weigh it honestly. Then finish the emergency fund. Your retirement account isn't one. Then open the box and fill the box. 2 actions, not one. Put something diversified inside. Check the fee. Automate it. Expect the drops. Let time do the heavy lifting. And there's one question I skipped on purpose, because it deserves its own video. What to do when a lump sum lands in your lap and you don't know whether to invest it all at once. The real answer is stranger than the internet makes it sound.